Ever feel like stepping into a casino when you see those stock market charts light up red and green?
Well, today we're calling out the high rollers and their tricks, strategies, I mean.
We're breaking down a YouTube video, really a live trading session from the Inner Circle Trader channel,
And this isn't some talking head spouting theories. This guy's reacting live.
to the E-mini Micro NASDAQ 100.
During a huge e-market event, the FOMC meeting.
Talk about pressure.
No kidding. The FOMC, that's the Federal Reserve announcing interest rates, can make or break traders.
And this guy, he doesn't hold back on the jargon.
Nope. Imbalance, checkered flag. It's like he's speaking another language sometimes.
Before we need a translator, can you walk us through some of those, like what's so great about imbalance? Sounds like a recipe for disaster.
Think of it this way. You've got those old-fashioned scales, right?
Like the ones Lady Justice holds.
Exactly. When one side gets way heavier, boom, imbalance. In trading, it's when buy-or-sell orders flood in for an asset.
So everyone piling onto one side of the scales, throwing the whole thing off.
Precisely. And that sudden shift. Traders watch for that. It often hints at where the price might go next.
So it's like spotting the ripple before the tsunami hits. He also keeps saying liquidity pools. Is this a NASDAQ or a SPA day?
Not a spa, thankfully. But imagine a bunch of buy-or-sell orders all piled up at a certain price.
Like a traffic jam, but for money.
Basically. Those are your liquidity pools. They can act as a floor or a ceiling for the price.
So the price either takes a breather there or slams into it like a wall. Okay, now he uses this metaphor of a checkered flag for some price points. Is he talking about actual races now?
He is. But in the trading world, that checkered flag is a price point that signals a downward trend.
Like the finish line for anyone betting on the market to go up.
Exactly. Even pros look for those simple signs in the middle of the chaos.
Speaking of signs, he's got one for everything. Running highs, sweeping lows. It's like he's narrating a stock market ballet.
That's a good way to put it. He's describing how the current price is interacting with previous highs and lows.
Like leaving clues for other traders to follow.
You got it. It gives everyone an idea of where the market might be heading next. But he also emphasizes that he's not blindly following those clues. He's watching the order flow, too.
Order flow, that sounds ominous.
It's simpler than it sounds. Imagine trying to predict traffic patterns.
Rush hour is always a safe bet.
True. But order flow is like figuring out not just where the traffic is going, but who's driving those cars. He's tracking the big players, institutions, because their decisions can really shake things up.
So it's like trying to guess the ending of a movie based on which characters just left the scene together.
Exactly. You're anticipating the plot twist based on who the movers and shakers are. But how does he actually do that? Does he have a crystal ball I don't know about? He uses a combination of things. He analyzes the charts, looks for patterns, and of course, uses his experience. One tool he uses is something called Fibonacci retracement levels.
Fibonacci, that sounds like something straight out of my college math textbook.
They sound scarier than they are. Think of them like horizontal lines on a chart, each line representing a specific mathematical ratio.
I'm already lost.
They're basically like magnets for the price, attracting it towards them. Traders use them to get a sense of where the price might reverse or speed up.
So he's got this roadmap with the Fibonacci levels as landmarks, giving him an idea where the market's going.
Exactly. All of this, the imbalances, the order flow, those Fibonacci levels, they all point to where the market is out of whack. Those moments where there's a gap between what buyers and sellers are willing to do.
He's like a detective, except instead of fingerprints and clues, it's these patterns and indicators pointing to a potential trade.
Right. And that's what he calls a setup, a combination of signals hinting at an opportunity.
Like that flashing neon sign saying, hot deals here.
Right. But he makes a key point. What works for one trader might completely flop for another. It's about finding what suits your style and risk tolerance.
So less about following a recipe and more like understanding the ingredients to make your own signature dish.
Exactly. And speaking of finding your own way, he stresses not blindly following what everyone else is doing, especially during something as volatile as the FOMC announcement.
Because if everyone jumps on the same bandwagon,
It could easily tip over.
and nobody wants that. So he's carefully watching how the market reacts, not just jumping at shadows.
Right. It's about recognizing those subtle cues, the winks and nods that tell you it's go time.
He's like a market whisperer, understanding its secret language.
You could say that. And that patience, that discipline to not get swept up in the moment, that's what separates the pros from the amateurs.
He actually points out a few trades he spotted during this FOMC announcement, right? But he's clear that they're not one size fits all.
Exactly. He even mentions one setup, he called it gambler setup, right before the announcement.
Sounds ominous.
He basically said he wouldn't touch it with a 10-foot pole. Emphasize knowing your limits, your risk tolerance.
So just because someone else is jumping off the trading cliff doesn't mean you have to follow.
Precisely. Informed trading, not blind leaps of faith. And what I love is he walks us through his entire thought process.
It's like getting a peek behind the curtain. Way more valuable than those buy low, sell high platitudes.
Absolutely. If it were that simple, we'd all be sipping cocktails on our yachts by now. Speaking of not so simple, he also talks about using different time frames on his charts.
Is he a time traveler now too?
Ha! Not quite. But he's essentially looking at the market from different zoom levels. The daily chart shows the big picture, the long-term trends, but then he zooms into a 5-minute chart to see those tiny details, the short-term moves.
So it's like checking Google Maps for the whole state, then zooming in to find your street corner.
You got it. You need both to get the full picture, make sure those short-term moves make sense within the bigger trend.
Like making sure you're on the right highway before gunning the engine.
Exactly. So we've got our charts, Fibonacci landmarks, our order flow traffic signals. What else does he use to navigate this FOMC frenzy?
Yeah, it's like he's got a whole trading arsenal at his disposal.
Well, one thing he keeps coming back to is that even with all the fancy tools and analysis, trading, especially during a high-stakes event like this, has a huge mental component.
He's not just talking about crunching numbers. It's about discipline, managing your emotions, not letting FOMO make you do something reckless.
It's easy to get caught up in the excitement, especially with those big market swings. But as he points out, not every trade is a winner. You've got to know when to walk away.
Reminds me of those friends who are convinced they can predict the Super Bowl winner every year.
Right. Until they can't.
Exactly. And then they never bring it up again.
That's trading sometimes. It's not about hitting home runs every time. It's about consistency, having a plan, and sticking to it, especially when the market's throwing a tantrum.
So less about predicting the future and more about rolling with the punches when it inevitably throws a curveball.
You got it. He even says that this entire trading session, while informative, might not have been the best for actually making trades.
Seriously. But there was so much action. It seemed like a trader's playground.
He called it choppy and unpredictable, even for him. Sometimes the smartest play is not playing at all, especially when the market's acting up.
So even seasoned professionals tap the brakes sometimes. That's oddly reassuring to hear.
Absolutely. Protecting your capital, that's priority number one. Profits are great, but not losing everything is even better.
It's like that old saying, it's not about how much you make, it's about how much you don't lose. But even though this FOMC meeting wasn't a trading free-for-all, he still managed to squeeze out some wisdom.
Oh, for sure. He talked about the importance of being adaptable, adjusting your strategy on the fly as the market throws curveballs. He actually compared it to surfing.
Surfing now, that's a curveball I wasn't expecting.
Right.
Does he keep a surfboard next to his trading desk?
Not quite, but he makes this great point about how surfers don't control the waves, they learn to ride them.
Right. You got to respect the ocean, work with it, not against it.
That's the idea. Surfers adapt to the size, speed, even the shape of each wave. They read the water, anticipate the next move, and react.
Sounds a lot like trading, actually.
It is, especially during big market events like the FOMC. It's less about dictating the market's moves, more about moving with it.
So we've gone from market jargon to serving metaphors. What a ride.
That's what we aim for.
So we've gone from market jargon to surfing metaphors. What a ride.
That's what we aim for.
But let's be real, not everyone listening is about to quit their day job to ride the NASDAQ wave.
True, true. But here's the cool part. A lot of what this trader's talking about applies even if you never buy a single stock.
Okay, now you've got my attention. How so?
Think about those imbalances he's always hunting for. Those don't just happen on charts. They're everywhere.
I'm listening.
Picture this. You're stuck in traffic. Most people, they just groan and crank up the radio.
Guilty as charged.
But someone seeing things like this trader, they'd look for the imbalance causing the jam, maybe an accident up ahead, and use that to find a detour.
So instead of just reacting to the brake lights, they're thinking a step ahead, finding the opportunity in the chaos.
Exactly. Or even simpler, that dreaded grocery store checkout
The
line.
bane of my existence.
Everyone just shuffles along, right? But what if you looked for a liquidity pool? Maybe there's a lane where everyone's just got a couple items.
So you're not just following the herd, you're spotting the express lane hidden in plain sight.
Exactly. It's a different way of looking at things. Being observant, thinking a few steps ahead, that's valuable no matter what you're doing.
You know, it was humbling to hear him say even HE found this FOMC meeting tough to trade.
Right. Even with all his experience, sometimes the best move was no move at all.
Talk about discipline.
Absolutely. It's so easy to get caught up in the moment, but knowing when to hold back, wait for a better opportunity, that's huge.
Like that old poker saying, you don't have to play every hand.
Sometimes the best hand is the one you fold.
Nailed it. And it all comes back to what he said about thinking for yourself. Don't just follow the crowd. Trust your gut. Do your research.
Make the decision that feels right for you, not just what everyone else is doing.
This has been a deep dive into the mind of a trader A&D, a masterclass in how to think differently.
From imbalances on charts to imbalances at the supermarket.
There's a life lesson in there somewhere.
Definitely is. It all comes down to be observant, be adaptable, don't be afraid to see things differently. That'll get you far.
Truer words have never been spoken. Well, on that note, we're wrapping up this deep dive into the world of the inner circle trader.
We learned a lot.
We sure did. About market mechanics, yeah, but also how a pro thinks under pressure. And the best part is, we can all use these lessons, even if we're not professional traders.
Exactly. It's all connected.
So until next time, keep an eye out for those imbalances in your own world. You never know what opportunities might be hiding in plain sight.